We're going to discuss why it's essential to have a risk management plan that factors in different scenarios, including banking collapses, funding delays, and other unforeseen events. So I'd like for you to join me in welcoming to the stage, first our moderator, Kenasha Paul, who is the director of Venture Miami's Opportunity Program. Dami Osunsanya Dada, who's the director and co-head of the Softbank Opportunity Fund, where she is part of the team that launched and manages a $100 million early stage and growth stage vehicle for underrepresented founders in the United States. Mandell Smith, a vice president and banker at JP Morgan Private Bank. Yinka Majekodunmi, CPA and founder at YM Worldwide. Let's hear it for our next panelist, please. Two mics in the chairs, and we set up. There's three of them.
Hello, hello. There's two mics.
Here, you got it? Try it again.
Hello, hello.
1, 2, 1, 2.
Hello, hello, hello. All right, Launchpad, come on. I need to get some more energy. All right, we're just bringing up the panel up. We're going to have a really great conversation. This is just so I can give you guys some context about what's going on with this panel. So as founders, we know that we are supposed to plan for risks. We know we are supposed to plan for unforeseen circumstances. And oftentimes we don't. But yeah, we have this amazing panel that we're going to bring up. And so that you can learn about the importance of planning for unforeseen circumstances, just in case there's any delay, and payroll, and overall managing your business. So waiting for one more panelist. Hold on. There we go. All right. He's tall. We can't miss him. Yinka, come to the stage.
Here he goes.
Yinka! All right, so while we have Yinka coming onto the stage, I'll introduce myself. My name is Kenasha Paul. I am the founder and CEO of Black Professionals Network, and I'm also the director of Venture Miami Opportunity Program, where I coach women of color founders on how to gain their confidence and tools to explore private equity as part of their fundraising model. And so this session here is all about founders properly preparing for unforeseen circumstances. We know that we're in challenging times right now. And while your focus may be to raise funds, operate your business, you got to plan for when things don't go accordingly, right? So first off, we're going to kick it off to Yinka. First, if you guys, everyone, could take some time to introduce themselves, tell me your name, title, and your company.
My name is Yinka Majekodunmi. I'm the commissioned auditor of Miami-Dade County, but I'm also the founder of YM Worldwide, which I started 20 years ago when I was in college, just as a service provider and support mentoring system for businesses and entrepreneurs who want help in anything numbers, financial management, financial strategy, overall business acumen. And so my passion obviously has always been around that area of just providing service and support and mentorship to the business environment. So I'm the person of all things numbers. I'm not just one person or one title. I do all things. I'm also a CPA for support purposes.
Hi, everyone. Can you hear me? I'm Dami Osunsanya. I co-head an early stage fund called the Softbank Opportunity Fund. Our thesis is we can generate outsized returns by investing in founders of color, so specifically Black and Latinx. My role is to help companies grow and scale And I'm a Miami native that just moved back about a year and a half ago.
Good afternoon, everyone. My name is Mandell Smith. I work for JP Morgan Private Bank here in Miami. I am new to Miami from New York, our private bank office there. And my focus as a banker advisor is to guide both founders, entrepreneurs, and business owners throughout their journey and help them reach their wealth planning goals.
Awesome, awesome. So we're going to get right into the conversation. So Yinka, you know that every day business owners face some type of unforeseen circumstance that impacts the way that they do business. So how can startup founders identify when those areas of concern arise so they can properly develop a risk management plan in the event of a financial delay?
Financial crisis, right? Our favorite topic. I want to start by saying financial crisis is universal, or the threat of a financial crisis is always universal, whether you're talking about individuals, a family unit, a startup, a business, a large corporation, or government. All of us have that. All of us and them have that threat. The assessment, right, of how you go about mitigating those threats really involves documentation and strategy around understanding your business risk. And I know for some, business risk or cash flow risk is hypothetical, but for startups, it's a day-to-day reality that they live every day. So they're more aggressive in the cycles that's required to manage that business. Now, I'll say, just for starters, before you even get to your cash flow because of the financial crisis, do you understand your business? And have you assessed your business risk? And something as simple as the pastel model, knowing the political environment, the economic, social, technological, legal, and environmental framework is pretty much the starting point, just to understand your business risk. Because for startups, your business risk is your first line of attack. You're still trying to develop your business model. Your product market fit is still not in place, and you haven't documented or understood that risk first. Once you've gone through that level of due diligence, we'll call it, you can now talk about cash flow. And for startups, again, this question is about startups specifically. I like to say that your strategy or your cash flow risk is not just a number on your balance sheet. It's not just your calculation of your burn rate. Is actually a process. And the process is more detailed than we'd like to get to sometimes. But I would always start by saying, start with the process, document the process. Your operational strategy for sure will impact you during the time of crisis. How you manage your accounts payable and accounts receivable, which is normally the basics of what you see on the balance sheet or what you hear every day, because you have to receive money from your customers and you have to pay your vendors. But how do you manage those relationships? For accounts receivable, we'll say, okay, do you understand your largest customers? Do you understand the size of what they owe you? What happens if your largest customer goes out of business? And what's the favorable terms that you've given them where they can hold on to paying you and retaining the cash before it gets to your business? So on that front, we'll say, understand your relationship with your customers, understand your largest customers, and then you go back to your accounts payable, which is your suppliers. And in that area, I'll say, understand your terms, but documenting your terms. The question I always ask startup founders or business generally, I'll ask them, what happens if your largest supplier goes out of business? What happens if you have unfavorable terms where you have to pay and release cash outside your business to your suppliers? Those questions for me are the starting points to managing the inflow and outflow of cash. Yes, we understand how to mitigate industry risk. A lot of startups know how to deal with the technological competition. They know how to deal with legal challenges. But just the inflow and outflow of cash and how you manage those relationships, understanding the favorable terms of your debt. I know debt has been a new phenomenon recently because of inflation and interest rate, but it's always been around. It's always part of the issues that startups face. And we hear 90% of startups go out of business. The question is why? The answer is very simple. They run out of cash. So in a financial crisis, the inflow and outflow of cash management is not just a thought process. It's not how you feel. It's not your optimism or your pessimism about your business. It's about documenting a plan and a process around your inflow and outflow of cash.
Great answer. So just to kind of summate, that at the end of the day, founders need to understand that how they manage their cash and having a strategic plan around not what the relationship with their vendors, the relationship with their largest customers is going to impact a full picture strategy with that. And so that they have to be able to understand that they have to plan for any unforeseen, because no matter what, if they're venture backed, if they're a small startup business, these things could happen. They run out of cash. And so this is probably a good piggyback for Mandell then. Then how can founders ensure that their risk management plan is regularly updated and adjusted to reflect changing market conditions?
Well, thank you, Kenasha, and I appreciate Yinka's response. So I kind of think of things, from a banking hat on. It's more relational, and I think that we do need to segment the types of individuals no matter where they are in their journey. So if we're thinking about folks in their startup phase or folks who are a little bit more in their growth or mature stages of the business, what I want everyone to take away, and at least this is our process, or at least my process, and how I think about planning. Number one, think about your asset allocation, right? So again, depending on where you start, that might mean different things to different people, but your asset allocation in the sense that how do you hold your assets, whether that just be cash, maybe you have some securities in your portfolio, and maybe you have a little bit of other types of securities such as alternatives, et cetera. And as a result of that, the next step I would recommend, or at least say, is thinking about carving out very early in that process what an investment policy statement looks like. So even at a very minimal scale, having some conversations with your advisor or your banker, and really thinking about what that looks like. So it's dovetailing on actually thinking about a strategic plan, but when you're sitting down, even at the earliest stage, what does that banking partner relationship look like? You want to carve out how are you going to hold cash in the situations of market conditions changing, and especially changing rapidly. For example, rising interest rates, a market sell-off due to business risk, due to financial risk, whatever the case may be. I think that investment policy statement at its basic sense will kind of give you a guideline going through. The second part is B, and I'm thinking about it in my head, which is the banking partner or the advisor relationship that you establish. And I think that's really important, especially for startups, whether it be on the personal side is the introduction that you have, or of course on your business side, engaging early with those relationships to make sure you understand what would be needed. Because sometimes your business may take an unexpected turn, in this case, as a result of a particular crisis. But let's say on the positive side, you may scale up a lot faster, may get access to that capital a little earlier. Are your business and your procedures reflective of the opportunities that are ahead of you? And the final piece that I would say is probably top of mind today is more about the C part, which is your cash, right? I think cash is a conversation that we're having with our clients, especially who may be concerned about where rates may be going. And also the other C that at least in the framework that I think about is your credit. So maybe the opportunity is to have a cash management or what we may refer to as a liquidity strategy, but in a similar sense, thinking about how credit actually works. And maybe it's too late in the sense that we might be going through a tightening period, but prior to going through these financial changes, revisiting that plan, going back to the investment policy statement, understanding what your professionals are saying, and then executing on those strategies as things may change. So that ABC approach is how I'm thinking of it.
Awesome. And so just to repeat, so the A is for asset, your asset management plan. Your B is for your banking partnerships and the relationships. And C is to consider the cash or credit management, making sure that you're liquid. So, okay, I hope you guys are taking those notes, making sure that you guys get that down. But Dami, we know for venture-backed founders, especially recently, things happen, right? And so there also has to be part of that risk management plan, has to be a communication strategy and also an overall investor strategy when you're a venture-backed founder and there is a financial crisis. How can founders better work with their investors in those moments of financial crisis?
Sure. I'd say the first step is only take money from investors that you trust. Now, if you don't trust your investor will not trust you. Because the whole point of this relationship is that we're betting on something that's really unlikely but could be extremely huge on the offset. So the goal is to have continuous conversations throughout the process, even before something bad happens, so that when something happens, you can easily lean on them. So tactically, what does that look like? If you are a startup founder, I'd say as soon as you raise any type of capital, monthly, written, emailed investor updates, even when things are going well or when they're not going well, that cadence of continuous conversation will build the trust. Because what investors want to know is that if something goes wrong, you have the capability to figure and navigate that out and lean on the right resources. Oftentimes, I think founders are ashamed or embarrassed, but it's a startup. We kind of know that there's going to be a rebel. You're trying to disrupt something. You're trying to create a new industry. There's a lot of rocks and valleys that will go through that, and investors are there to be there for you if they know what's going on. Now, obviously, it'd be ideal as soon as you raise any type of capital, you started your investor updates. But it's still never too late. So if you haven't started the relationship, go ahead, call your investors, meet them once a month, have the dinners, have the email conversations, because it's really important to establish that. The second part we've alluded to is cash is king and cash is oxygen. So if you are running into trouble, how are you thinking about different ways and unique ways to raise capital? Sometimes because of the investor's thesis, they may not be able to come back into that next round. Or it's harder to sell to the investment committee because you haven't been doing well. So how do you start being creative and showcasing that you can get angels, you can get grants, you can kind of think outside the box to be able to raise that additional capital? I think oftentimes founders forget that this is a relationship and trust business. So doubling down on that through the entire process and the life cycle of your company will not only have you have investors that are with you from day one, but then they'll garner new investors. So I have a few companies now that, you know, they're not doing as well as we thought, but I'm still helping them raise and think through next steps and their P&L because they've come to me in an honest way and we know we're in this together. Think about, like, my favorite story is like the Airbnb guys, where at one point they were selling cereal boxes. Like, very huge pivot from where they were supposed to be. But they trusted and worked with investors to help navigate through that tough time, and they came through the other side. And that's our hope for our companies as we're investing. So don't be afraid of signaling when something is wrong. Be open and be transparent. And if you don't trust your investor will not trust you.
Great point, great point. So remember, trust is king, cash is king, and be able to have those investor conversations. If you're not having them already, start having them. Make it a frequent just practice to be able to have regular communication. And I would say not only with your investors, but all across the team, like being able to create that company culture of trust and transparency. And so I will go into, I guess, one of our final questions of like, what is the best practices from all of your different industries, experiences and sectors that you've seen founders implement in creating a qualified and, sustainable risk management plan? Yinka, we'll start with you.
Like I said earlier,
The mic.
I think I started up saying it's about really the formality, because oftentimes you get into this, I'm very optimistic about the future mentality. I think the best practice is the formality of designing the plan. As far as creating a document and getting, everything that everybody said today is very similar. Is about managing your cash. And so the documentation for me is the key, because sometimes it's hypothetical, but if you're creating a document in the crisis, you're probably already late. So for me, the best practice is just starting with the documentation of what your risks are and how you're going to mitigate them. And today we've heard a lot of different type of risks, but you have to document them, see how it applies to your business, and have a mitigation strategy for those risks. And in the case of banking, because we have bankers on stage, I want to add that probably if you're also lucky enough to have over $250K in cash, you may be thinking of a banking relationship diversification strategy in case one of your banks don't exist anymore. Put nicely. So that's my idea around trying to make sure it's formal and it's documented.
So just so I can piggyback on that, you're saying that because every industry has its own unique risks. So you're saying that for a founder, they should look at their industry and identify what are common risks that is associated with their industry and then pre-plan around that. Absolutely. And so having a practice of that strategic planning is specifically catered to their industry.
Absolutely.
Awesome. Dami, what about you? What is best practices you witnessed?
Yeah, I'd say earlier than you think, start putting governance structure in place. So that is documentation, that is having investor meetings, having all hands with the teams, even if it's 5 or 6 people. Because with all the dynamics that's happened over the last year, I think what we've lost touch with is being a little less founder friendly. I think we went extreme, where like founders can do whatever but there's a reason you have a board. And there's a reason you have people kind of watching over, because in moving and breaking fast and going too quickly, there's a lot of risk in breaking something that's unrepairable. So how do you put governance in place so that you have processes in place if things go wrong, whether it's an HR issue? Like there are companies that had to lay off people and didn't do that very thoughtfully. So as a result, they have legal issues. Like that's not something that you would think when you're saying, hey, I have to cut costs very quickly. But if you have processes in place, align with legal, et cetera, you'll be able to mitigate those type of risks. So earlier than you think, putting those processes on paper is the best way to go.
Love that, love that. What about you, Mandell? What are some best practices if you witnessed from the private banking side?
Excellent. So, I love working with other financial professionals. We do very different things, but very similar. So, obviously have a plan. And I think that's important when you're having a conversation with whoever your advisor is or your banking partner. I think, how do you go about finding out if it's the right fit for you? I think you think about who is your, biggest competition maybe. And if you know that person on a cordial basis or those founders, et cetera, maybe try to understand what their relationships look like and maybe get a referral from them. I typically defer to my professional advisors, in the network to kind of understand who are some of those other sources that people can reach out to. So I think that's a proper way to go about it. And it wouldn't be in my fiduciary capacity from a planning perspective to not talk about other risks outside of just the cash and how to get through day to day. I think that's the most important. But starting to think about what your insurance risks are, because that's generally the foundational part of where we start. So just to keep in mind, outside of the structures that we've talked about, do you have the right liability insurance? Just because you just started up, it's bootstrapped, doesn't mean that you don't have those inherent risks. So for example, if you are going into someone's place of establishment or business and you're delivering a good, do you have the right type of insurance? Or at least think about that. So that in a proper plan, in my opinion, that should be a component. Another big thing, or I think a trend that many of us probably are aware of, is the cyber risks. So starting to think through what that actually looks like, if you're especially doing your business over the World Wide Web, et cetera. And I think finally, again, at different stages of a founder's journey, you're also going to start thinking about what are those critical components. If something happens to me and I'm a founder and I have a partner, how do I continue that business? So we generally have those conversations and start to think about key person insurance, et cetera. So I don't want to get too product specific, but I wanted to leave you all with some things to think through, because depending on what stage you're at, you might be at those critical pieces in time.
I love that. So just making it clear that these type of insurances, this is across the board, no matter your business, you should be thinking about those things, because it's beyond just cash flow that might be an issue. You might have a founder who passes away, or you're the founder that whatever issue that happens and that you don't have anything in place to be able to make sure that the business continues. Okay, so we're coming up close in time, so I wanted to be able to kind of have each of you all leave a final remark about what advice that you would give to a founder, especially early stage. I feel like Launchpad really attracts a lot of early stage founders. Maybe some of them already have angel investing, already has venture back. But what are some advice that you would provide them across the board when it comes to pre-planning and having the process that you feel like you haven't touched on yet? Whoever wants to start?
Sure. So in summary, just think of your asset allocation and/or creating a plan around your investment policy statement. So your A, your B, establishing the right business partner, banking partner, advisor partner, and C, just thinking about what that liquidity strategy, that cash management strategy looks like. And again, depending on your journey. I would say in closing, what we're all probably encapsulating here is just having a plan. I would say to my clients and my prospective clients, be curious, ask questions. We may not have all the answers as the professionals, but I think if you're working with the right team of professionals, you'll get the right answers, and they'll navigate you to the right place.
So I struggle with the concept of a plan, just because with the nature of startups, anything can you could just pivot. I just think what's most important is having mentors and advisors that you can trust to give you good guidance. You don't have to go it alone. So as you're launching in this very interesting time, you're launching your businesses, you're continuing on with your businesses, relationships matter more than I have ever thought, actually. I've learned being an adventurer the last 4.5 years. The right relationship could get you to the right expert to help you mitigate a big risk. The right relationship to get you to the right customer. So obviously putting your head down and building is really important, but leaning on the right mentors and having a support system. Being a founder is a very lonely and difficult journey that none of us on stage actually understand. So working with a network of other founders, getting advice from mentors who've done things before, I think is actually a really unique way to reduce your risk.
Everything they said, but those are good answers. I don't know what I could add to that, but I'll say that in my experience, I think founders have a lot of challenges. They're moving very fast. They have competition. They're trying to get to their end goal. And in that journey, they often miss out on documentation and the formalities that they need to be successful. And so what I always would add to the conversation is there should be a certain level of formality. Relationships, the help and the support that you need could help you get to the formality. And so just documenting those formal things that you need on your risk assessment, understanding your operation, making sure you know relationship, understand the terms. You're raising funds. Do you have a place where you could go to understand the risk? Is one of your convertible notes going to come out earlier than you plan to? Or are you going to lose sight of it? So I think the formality of documenting all the things happening in your business from a strategic standpoint is often what I always advise. And the help is always available. Trusting your professionals, like he said, asking for help is key. I think that's the indication of a key successful path for you, in my opinion.
And I agree, and I think what you both have said that could be something. I know that Stephanie, she's a founder in our Venture Miami Opportunity Program, and she talks about her friend garden and how important it is for if you don't have, because I know founders always feel like they're strapped for cash and that they can't lean on experts because they can't afford it, but you can tap into your resources and your network, and they'll be able to provide you free, qualified expert information because you nurture that relationship. And for me, I'm all about networking because as a founder of a Black Professionals Network.
I said no founders. I'm sorry, girl. You
are
a founder.
I was just
Us
like,
three.
but nobody's fine. It's like, I'm all about networking, all about teaching our community the power of networking and building out their social capital, because we know that when you are strapped for cash, you need to be able to tap into either your network, your friend garden, your resources, your mentors and advisors. Okay, so thank you guys so much for providing such a wealth of knowledge. Please let everyone know how they can be able to reach you after if they're not on the app. If you're not on the app, share.
I'm on the app, so I can be reached on the app.
Okay.
Dami Osunsanya on LinkedIn.
Awesome.
And Mandell Smith on LinkedIn, and I'm also on the app.
Awesome.
Pleasure to meet everyone.
Awesome. And thank you, everyone. And this was a pleasure to be able to host a session on mitigating risk amid a financial crisis. Have a good one, y'all.